Can you guys hear me okay? Yeah. Great, fantastic. So I was just in New Orleans doing an event last night, and I get the opportunity, especially this time of year, to travel around the country and meet with different investors and hear what they're excited about, what they're worried about, what they want to learn more about. And I've found the tone of sort of the subject of their questions has changed a little bit in recent months. So earlier this year, and I'd say certainly last year and probably the year before, the questions I was most often getting as I travel around the U.S. talking about global markets, there were worries about things like the Brexit vote, about all the student loan debt out there, about certain elections, about what was going to happen. Any one of these potentially negative things, or even some that were definitely negative things like the defaults on student loan debt, is that going to be enough to topple a global economy, pull us into a recession, cause stocks to pull back sharply? That was the focus of the concern. All these little worries. That's changed in recent months. I think people have recognized that the economic backdrop is pretty good. Markets are doing pretty well. And now the question is it too good to last? Right? So it's gone from these little worries to this big picture of, yeah, got that it's good, but I'm still worried it's too good to last. So I want to focus my 20, 25 minutes or so on answering that question for all of you. We at Charles Schwab, probably about as bullish as we've been in a very, very long time this year. Liz Ann Saunders, who you may know, covers the U.S. for us in great detail. I'm the global guy. U.S. is part of what I do, kind of do the big picture. We are very positive on the equity markets, have been and continue to be as we look out over the next year or so. And I want to share that perspective with you and why I think you probably find some value in that and hopefully some comfort in that. So I'm going to give you kind of why we think that. Then I'm going to step back think a little bit and address some of the concerns people have when they worry that it's too good to be true. Or too good to last. One is, are we on the cusp of the next recession? I'm going to address that. When is that one coming? What about bubbles? Well, we had a housing bubble, we had a tech bubble, right? We know bubbles happen. We know they can take down the markets and the economy. Where's the next bubble? What's it going to do to us? And then finally, valuations. Got that things are good, but are stocks too expensive now to buy? And where are they too expensive? Where are they cheap? I want to talk about that as well. So that's kind of the backdrop of thank you. Oh, that's great. What I want to go through, and I want to start out with a whole bunch of red and green. No, it's not Christmas time. It is, well, it may feel that way because the markets are doing so well. There we go. I aim this way. So here we go. Don't worry about the numbers. You know what red and green means, right? So these are months across, right, and years from top to bottom. Ignore the top line for a second, which is just the average for the last 30 years. Look at the 2017 line of monthly returns for this year. Notice anything? Yeah, they're all green. That has never happened before. We've never seen 9 straight months for January through September of all green. We once had 5 in a row of months. This is for global stock market, all the stocks in the world on average going up 9 months in a row. It's amazing. And actually, if you add the last 2 months of last year, right, November and December of 2016, you get 11 months in a row. Now, that's only happened one other time. It ties the all-time record, which began right there in 2003 through early 2004. That was right after the tech wreck ended. Right after all the dot-com stocks that went up came crashing down over 2.5 years, fell 50%. The market finally bottomed and then went up for 11 months in a row after a 50% decline. We just got 11 months in a row. We didn't have any 50% decline, right? Everything's been doing really well, and stocks are just marching steadily higher. So I get it. I get this idea that maybe things are too good to last. This seems like an incredible streak for a market that hasn't suffered any pain in a while. But I think it's rooted in fundamentals because of this green. This is economics. These are countries, not stocks. So, I'm sorry, hit the wrong thing. These are countries, not stocks. Here's 2017. So this is the green I want you to focus on. This is on the scale there of 0 to 45, the 45 largest economies in the world, accounting for almost all of economic output in the world. 2017, every one of them is growing. Some are growing faster than, the darker green means they're accelerating in growth, the lighter green means they might be slowing a little bit, but every single one is growing. It's been a long time since we've seen that kind of growth, right? In 2016, Brazil, Russia, among others, were in recession. 2015, Japan was in there. 15 was Canada, 14 was Japan, 13 Italy. Major world economies in recession, pulling down sales, pulling down earnings, and weighing on the stock market. Not happening this year. Unbelievable broad growth, not just stronger growth in the world that we've seen in a while, but broader as well. If this is a stool that we worry about knocking over, it now has 45 legs on it. Hard to knock over a stool with 45 legs. That's great news. You know, we're right here. This is the forecast for 2018 from the OECD, big macro forecaster. The IMF just published their forecast last week. All the big forecasters are out, expecting 2018 to be the same story. Now, forecasts are just forecasts, but still, one of the most positive, robust, strong, fundamental backdrops for stocks in a long time. I think this green explains the green on the prior slide. You see, this hasn't been about Trump. People call it a Trump rally. It has nothing to do with politics. This isn't about hope for tax reform, changes to trade agreements, health care, none of that. This has all been about better earnings growth. This is what you want stocks to go higher on. Look, two lines on this chart here. One is earnings. That's the scale over here. Earnings for global companies. The other scale over here, the stock market, the global stock market. Earnings and stocks have been doing the exact same thing. It could basically be one line, right? So stocks really since about 2 years ago bottomed, been headed higher, so have earnings in lockstep. Here's the Brexit vote, right? So you see the blue line, the stock market, little volatility, but reconnected right there with the orange line, earnings. Here's the U.S. election. It's not pricing in something that hasn't happened yet. It's been moving up with that better, broader economic growth that's supported global earnings, and that continues. Our forecast is it's true again in 2018. Broad global economic growth means continued earnings growth, means continued stock market gains. Maybe not every month is green, but the trend over the next year very likely to be green. That's really important. So that's the backdrop. In a nutshell, why we're so positive. It's not complicated. Simply, everything's growing. That's a really good backdrop. It's what you want. You don't want stocks going higher on hopes for some change that may or may not happen. You want them rooted in the fundamentals of better and broader global economic and earnings growth. So that's great news. But how do we know it's going to last? Right? I mean, that's the question. Got that it's good. How do we know that we're not on the cusp of the next big recession? It's going to cause earnings to collapse and the stock market along with it. Well, you've seen me present before, some of you. Maybe you're going to recognize this chart. This chart has been, for 20 years, every time I present, I use this chart. You'll see why in a minute. I know it's not much to look at. I know it's crazy looking. I'm going to explain it to you. I'm really talking about this purple line. The purple line is what we call the yield curve, or the yield spread. It's simply the difference between long-term interest rates and short-term interest rates. It's that simple. Usually the difference, long-term rates are usually higher than short-term interest rates by 2% or 200 basis points, what we call it in the industry. Right? So you just kind of look at the 200. That's about on average where that crazy purple line is on average. But it's never there for very long, is it? It's either above it or below it, zigzagging past it like crazy. This is the last 50 years. It's done a lot of moving. Why does it move so much? Well, one of the reasons is the Fed. The Fed hikes short-term interest rates when we get late in an economic cycle, right? As they are now. They hike short-term rates. So what happens is the gap between short and long-term rates narrows, gets to zero. And then they actually push it higher. The Fed actually pushes short-term rates higher than long-term interest rates, the 3-month T-bill yield above the 10-year Treasury yield, which is very unusual. But when they do that, and I've marked it 7 times on this chart, I've marked each one of those with an orange dot. 7 times in the last 50 years, this unusual relationship, the Fed pushing rates above long-term rates, every one of those, I don't know if you can see them, preceded these 7 gray columns. Can you see those? You know what the gray columns are? Yeah, because crazy guys like me, we use all kinds of charts and colors, but gray columns mean one thing. bad news, right? Whenever you see gray columns, it's not good. Those are recessions, not just US recessions, global recessions, where world economies fell into recession, they contracted, we lost jobs, we lost earnings, and stocks fell. So it's an amazing tool. It has told us when short rates get above long rates, recession's coming in 1 year. Never been wrong in 50 straight years. Never predicted a recession that we didn't get. Predicted every one we did. Amazingly accurate track record. Does a great job internationally as well. What an incredible track record. But not just that, because we care about the economy. We do as investors, but we really care about the stock market, right? So that's what that blue line is. The blue line is the S&P 500 stock index. And if you take each one of those orange dots, I just drew those lines straight up to show you that whenever we get that strange relationship with short-term rates getting above long-term rates, it coincides almost to the exact month the stock market peaks, ahead of what is a 20, 30, 40, sometimes 50% decline in the stock market. Ouch. We want to avoid those when we can, or prepare for them when we can. So what an amazing tool. I mean, I was on yesterday morning before I flew down to New Orleans. I was on Bloomberg TV for an hour. I think 2 days from now I'll be on CNBC for an hour or so. Look, we get rid of all of these financial news television shows and just have yield curve television. And it'd be boring, but it'd be great, right? Never been wrong. Amazing tool. Tells you recession's going to happen in a year, on average between 6 and 14 months. And the stock market's peaking now. But what's it telling us right now? What's it saying? I think it's saying two things. One, that there's probably not a recession in the next year. The best forecast I know, I don't know any economists who have a perfect 50-year track record. Do you? I sure don't. This does. And it's saying we're not there. So no recession. Earnings are likely to continue to grow, global economies continue to grow, and stocks continue to trend higher. But where's it headed? It's headed down, right? We know it's headed to zero. The Fed is hiking short-term interest rates. We're not seeing much of a budge on the long end. So we are going to get there. When? When is it going to tell us? Well, the Fed's estimates probably put where they would get short rates equivalent to long-term rates somewhere around the end of next year, 2018, which would put the recession at the end of 2019. Well, the bond market's saying, don't get ahead of yourself, Fed. It's going to take you a bit longer than that. It might take you another year. That means the yield curve wouldn't invert. Short rates above long rates until the end of 2019. The recession comes in the end of 2020. I don't know. I think this will tell us. I think we need to pay close attention to this because we're no longer early in this game. We're getting late. It's like the 7th inning stretch. This could go to extra innings, but it's getting late. We got to start paying attention to this. Thinking about cash needs, thinking about rebalancing portfolios, making sure that we're focused on where we're headed. But where we are for the next year, maybe 2, is higher. Continued broad economic growth, continued earnings growth, right? So it's not, the next recession, bear market isn't 5 years away. It's not 1 year away either. It's somewhere in the intermediate time. Again, still positive upside. So we remain positive on these markets in the near term. Usually the last year before the yield curve inverts, stocks are up double digits. And I don't just mean usually, I mean every time for 50 years. So it's a good time to be invested in the markets. Don't need to be bracing for that downturn yet. So I started we're really positive because of this fundamental growth backdrop. Yep, don't see a recession around the corner. Yep, favorite indicator. But what about bubbles, right? What about the next bubble? What could make the yield curve wrong for the first time ever? Remember, it inverted in 1999, told us the tech downturn was coming. In 2006, to tell us 2007, 8, and 9 was coming. So it caught the last 2 bubbles, but what if it's wrong this time? What if there's a big bubble out there and it's just not showing up and it's about to hit us? How do we know? Well, I think we've got to decide what a bubble is and then apply it, right? So when I think about bubbles, stuff goes up and down all the time. This is what I think a bubble actually looks like. A potentially disruptive bubble looks like this. I've just indexed the last 4 major bubbles to their peak. And what you'll see here is I've got the tech bubble on here with the NASDAQ stocks, got housing on there with home builders, oil prices, precious metals. They all follow the same pattern. They all go up 1,000%, exactly, really, within a few percentage points, over 10 years, almost to the week. 1,000% over 10 years. That's what a bubble is. Every one of these had major ramifications for the global markets. We all remember the big tech bubble and the burst, right? And how they fell so sharply afterwards. It wasn't just tech stocks that fell. It wasn't just home builders that fell in 2008 and 2009, right? It was the entire economy. It was the entire stock market. And that's why the 10 years is so important, as I note. Because it's not just the magnitude of the gains. Of course, that's important. You got to have a bubble, so it's got to go up a lot. But the 10 years is important because that reflects how embedded that flawed thesis gets in the economy, how much it weaves its way into the fabric of the markets in the economy. It takes that long for housing to have gotten so embedded, this flawed idea that home prices are never going to fall, that it became embedded in everything. Too much leverage, too embedded in everything, boom, it blew up. Same thing with the tech bubble. Oh, it's great for everything, right? Not quite. So that flawed idea takes a long time to become embedded. When it is proven to be flawed, it takes everything down. So this is the model for what a bubble looks like, I think. At least the destructive ones, the ones that take down everything. So anybody have any ideas about what I'm most asked about today? What the most common ideas? Is this a bubble? Anybody can guess? Most common thing I'm asked about from a bubble perspective. No, no. These are all good. These are all good. No, number one, Bitcoin. It's usually the first thing out of anybody's mouth. Bitcoin, right? You guys know Bitcoin, cryptocurrency, right? This is a wave of popularity of amazing. I understand why I'm being asked about Bitcoin. Because that's Bitcoin. Yeah, whoa, is right. This is just since the beginning of 2016. That red line is what Bitcoin has done, 1,000%. I only started at the beginning of 2016 because that's when it kind of got popular again. Bitcoin actually goes back to 2010. It's had another bubble and it's come down and then it inflated again. But if I took this chart all the way back to 2010 and the start of Bitcoin, well, that line would go way up through the roof because $1,000 of Bitcoin in 2010 is worth $58 million today. Yeah, so I know why I'm being asked about it. Is this a bubble? Now look, I don't know if Bitcoin is going to go up another 58 million or come crashing right back down again. We can all have separate views about the viability of a currency that's not tied to a government or a central bank, and the fact that there are 100 different competing technologies, hundreds of different cryptocurrencies out there competing for Bitcoin's marketplace. Set that all aside. I don't think this is a bubble that's going to take down the broad financial markets and the economy. It's just not that embedded. For one thing, it's only a year and a half. And the second thing is it is naturally an independent thing. It's not part of the financial markets purposefully, right? It is a totally separate thing. Were it to go down, heck, it might strengthen the traditional financial system. So I don't think, even though I'm asked about it everywhere I go, number one question I'm asked, I don't think this is a classic bubble. Were it to blow up, that it would cause some kind of major catastrophe, cause the yield curve to be wrong, cause a big bear market. I'm not worried about this one. What about this one? The FANG stocks. Internet retailers. Look at that. That is 1,700% over the last 8 years. Since the market low back in 2009, I'm talking about Amazon, Netflix, Priceline, all these big internet retail names. Unbelievable performance. And people are saying, well, why isn't this just like the .com? I mean, why isn't this just like another big NASDAQ bubble that's just going to explode? These things are going to come crashing down and take everything with it. Here's why I think it's different. Back then, the internet was viewed as just wonderful for everybody. It was good for online retailers. It was good for brick and mortar retailers. It was good for online media. It was good for print media. It was good for everything. Everything went up. You had the entire tech sector, the telecom sector, media stocks. About 40-50% of the stock market soared. These guys account for 6% of the stock market, just 6. If they blew up, yeah, you'd feel it in the tech sector, but I don't think it would have the same broad impact. Remember, this hasn't been good for everybody, right? I mean, you only have to open up the paper to see what's happened at Toys R Us or Nordstrom or Macy's or any of these, right? I mean, there's been a big impact. The overall retailing sector, these guys are a part of it, but so are the brick and mortar guys. That index has done okay. It's done nothing like this. It's up maybe 300-400% over the same period. Nothing like 1,700. So I don't see this as a destructive bubble. Certainly these stocks have gone up a lot. Maybe they go down, maybe they continue to go up. But if they were to crash, might change the leadership in the market away from the tech sector, but probably not going to undermine broad global economic growth in 45 different countries. So worth asking about, but I don't think that's a risk. Here's another one I get asked about, central bank assets. This is tied to debt in a way, right? So since we were in the financial crisis, all the central banks, the Fed, the European Central Bank, the Bank of Japan, have bought up all these bonds to try to push down interest rates and get money into risk-taking assets and push up the market and encourage investment by businesses. I don't know it's entirely been successful, but it's certainly something they've been aggressive about. But look at this, it's up 300% over the last 10 years, not 1,000. It's a lot of money. We've got a huge problem with debt in this country. Frankly, every developed country has a big problem with debt, long term. But debt exacerbates downturns. It doesn't cause them. It makes downturns deeper. It makes them harder to get out of. It's usually not a catalyst for a downturn. So I don't think this is a bubble. I think as the Fed begins to unwind its balance sheet, sell some of these bonds, it's going to be a very slow process. I don't think we're going to see some kind of bubble burst that would make the yield curve wrong, pull us into a big recession. All right, last one of the bubbles, passive investing, ETFs. Are ETFs a bubble? Money's come out of mutual funds, gone into ETFs. It's the new vehicle of choice for many investors. Is it a bubble? We don't tend to think about vehicles as bubbles. We kind of think about where the money's going. It's just coming out of one pot into another pot, but ultimately it's going into the same stocks, and maybe it doesn't really matter that much, but people still ask, is there too much money in passive investing strategies? I don't think so. I don't think that's the right way to think about a bubble. But it's interesting, and it's worth more discussion. But as I look at this, if it is a bubble, now's when I want to own it. Look at that. It's going to go up 500% in the next 2 years. I'll take that, right? So I don't think it's a bubble, and I don't think that's going to happen. But look, it doesn't look like it's on the cusp of bursting. If anything, it might be going the other way. So as I look at the 5 most common bubbles I'm asked about, or bubble candidates, none of them qualify, in my opinion, as something that's going to make the yield curve wrong, dip us into recession, and end this streak of gains. I think we're going to continue to see this broad economic growth from this perspective. Yeah, so valuation, I heard that. Yeah, let's talk about valuation. Fine, got it, things are good, but are they too good? Are stocks just too expensive? The way I like to look at the stock market is on a price to earnings basis. Take the price, divide it by the earnings over the last 12 months. What do you get? And they're above average. Stocks are a bit above average, about 17, 18 times earnings if you look at the global markets. In the US, it's about 20 to 21 times earnings, and that's above the long-term average. But it probably should be at this point in the cycle where earnings are growing as rapidly as they are, double-digit earnings growth. That doesn't bother me too much. It's important to keep in mind that the current price to earnings ratio has no correlation, no indication at all as to what returns do in the next year. Has a huge impact on what they do over the next 10 years. The price you pay, critically important to your long-term return, which is going to be below average. Going to be below average. We're not going to get 10, 11% that we saw going back on average for the last 70, 80, 90, 100 years. Maybe more in the 6 or 7% range, I believe. We believe at Schwab. But in the next year, no relationship at all. Zero. No correlation. So don't get too caught up. Our valuation's too high for what stocks are going to do in the next 12 months. Nothing there. Just tells you about the long term. But where are markets more expensive? If we're looking at a market that's a little bit above average, are there markets that are below average? Should we be allocating money elsewhere based on purely on valuation? Let me talk to you about that in the context of how markets perform. And I'm going to start, it's a little obscure, but I'm going to start with Canada, just because. I'll show you why. So here's the blue line on this chart. Since 1999 is the Canadian stock market. Canadian stock market's up 300%. That's amazing. Because the world stock market, which is that dotted orange line you see up there, that's the world. Half of the stocks in that index are U.S. companies, right? That's the broad, developed global stock market, right? It's up 100%. So Canada has absolutely killed it. It's done amazingly well. Why? Why? Is it better monetary policy, better politics? Is it maple syrup? You think it's maple syrup? No, it's none of those things. It's the purple line. You may not even be able to tell. There's two lines. There's a blue line and a purple line. They're right on top of each other. All I did with that purple line, I created it. I just did 1.3 times the World Energy Stock Index. Canada is a levered energy ETF, period. All you need to know about Canada is where oil prices, where you think they're going. Who cares who wins the next election? Who cares what the central bank does? I don't care what the unemployment rate is. Oil is everything for Canada. Take a look at this. When oil prices from the middle of 2014 to early 2016 fell 50%, so did Canada's stock market. It's all that matters. The funny thing is, though, the biggest sector of Canada's stock market, it's not energy. It's banks. 40% of Canada's stock market is just banks. That dominates their entire stock market is the financial sector. But who do those banks lend to? They lend to natural resource companies, right? And they're all, like the entire Canadian economy is tied, whether it's timber or natural gas or oil or whatever, everything comes back. I don't care if you're a healthcare stock, a consumer stock, a bank stock, your fortune is tied to what happens to commodity prices, including oil. And that's why the entire stock market behaves this way. The point is to focus on valuation. Canada's stock market, much like the US, North America, is expensive relative to the rest of the world. But here's why. Canada's stock market trades at a 20 price to earnings ratio. So does the energy sector. Energy sector's PE is 21. It's valued like it performs. The average financial stock's only valued at 14 times earnings right now. It's cheap. Financials are cheap. And if you looked at Canada's stock market, with much of it being in financials, you'd think, wow, Canada's really overvalued right now. But it's not, because it acts like financials. It acts like energy, and energy is priced at 21 times earnings. It's fairly valued. Here's one that tracks financials. So here is Japan. Japan is the blue line on this chart. For the last 10 years, Japan's stock market's barely done anything, basically zero. It's underperformed the world stock market almost as much as Canada's outperformed, right? Why? Is it bad demographics, zero interest rates? No. It's that everything acts like a financial in Japan. That's the purple line here is the financials index. And the funny thing about Japan is the biggest sector of the stock market's not financials. It's those big consumer brands we all know, right? It's Sony, it's Toyota, it's the consumer stocks. But here's the deal. Those companies own shares in the banks. The banks own shares in those companies. It's called keiretsu. It's this relationship in Japan that's been around for decades, and it means everything acts like a financial stock. Sure enough. And everything's valued that way. Even though the consumer discretionary sector right now trades at 20 times earnings, Japanese stock market's 14, because that's how financials are valued. So people look at the US or Canada and they go, wow, 20, 21 times earnings. It's expensive, I'm a little worried. Why don't I buy some Japan? That's fine if you want financials, but you're only getting fair value for financials. That's what Bank of America trades at in the US, Santander in Spain, Deutsche Bank in Europe. They all trade at 14 wherever they're located around the world. That's what you're getting for Japan as well. So I don't see any substantial value there, anything separate from how it performs as we look around the world and see different valuations. So let me just do two more with you real quick here. This is Europe. The Eurozone is 19 different countries. So it doesn't just track one sector. It tracks three, actually. Blended almost one-third, one-third, one-third. Financials, telecom, and materials. You'll see the blue line tracks that purple line very closely. 17 times earnings, price to earnings ratio. This is how Europe is trading right now. Sure enough, if we blend those three sectors together, 17 times earnings. Last one, U.S. stock market. U.S. is a tech ETF. The U.S. stock market tracks tech pretty perfectly. I mean, maybe in the last couple of months, tech has really taken off and U.S. hasn't kept up to the same pace, but look at that for the last 10 years. There's a 0.99 correlation. They are the same thing. Tech is the biggest sector in the U.S. It's just amazing how closely we track it. Remember this dotted orange line here is the world stock market, and half of those stocks are U.S. companies? We ought to be tracking that perfectly. Only 20% of U.S. companies are tech stocks, but that's the line we track. It's all about tech. We've got a lot of sectors in the U.S., right? We've got fintech and health tech and consumer tech and tech. Everything's tech in our economy. It really comes back to technology. That's what drives us, and that is how the U.S. stock market is valued. If you take a look, the U.S. is trades at a PE of 21. Remember, very similar to Canada, North America, rather expensive relative to the rest of the world. But tech's at 23, right? Just in the last couple of months, tech's pulled up a little bit. Otherwise, they're usually exactly the same. So I don't see any valuation reason to look around and say this market's expensive, that market's cheap, they're out of balance. Every market looks pretty fairly valued based on how it performs. They're all a little bit above their long-term average. That doesn't worry me at this stage in the cycle. Over the next 10 years, count on lower returns than what you may be used to over the last 50 years or so, but it doesn't affect their outlook for the next year, and it doesn't look like the U.S. is vulnerable and Japan is a really hot place to go. I think global diversification still makes a lot of sense in this environment because, look, if you've got all your money in the U.S., you got a huge bet on tech. And that's been great for the last 3, 5, 10 years. Tech has outperformed, right? It's outperformed the world market, but it hasn't always outperformed. I can remember back here, I'm sure you can too, in the early 2000s, where tech was not the place to be, right? Tech underperformed, so did the U.S. relative to the rest of the world. That's why it's important to have sector diversification in your portfolio. Therefore, you've got to have geographic diversification in your portfolio. You can't get one without the other. And right now, I think it's a really good time. As we get to the latter stage of the cycle, broad diversification makes a lot of sense to stay engaged in the stock market. So again, broad global economic and earnings growth pushing the stock market up. That's what you want. No recession in sight for the next 12 months or so. No bubbles out there that we're looking at that seem to be very worrisome right now that would make us wrong. And from a valuation perspective, stocks are a little overvalued. That doesn't affect our outlook for the next year. And we're not seeing places where the U.S. is, say, overvalued versus other parts of the world. They seem to be all fairly valued out there, and the market's got a fairly solid basis for a continued advance. So let me stop there, and I will turn it over. I'm not sure who's next. Do we know who's next? Fantastic. So, and we're going to hold questions until we're all up here and can argue with each other and punch it out. I don't know if you saw us in the parking lot, but it was getting pretty rough.